For the last 56 years, two simple momentum rules have quietly beaten the S&P 500, not by a little, by nearly 2 percentage points a year, with half the drawdowns. Two rules. Checked once a month. That is the entire system. It was published in 2014 by Gary Antonacci in his book Dual Momentum Investing, and the evidence behind it spans over 5 decades of market data. Today I'm going to show you exactly what the two rules are, why they work, and what Antonacci himself calls the limits of the strategy. Every investor faces the same two problems. Buy and hold in a single index will make you rich over 30 years, but you will ride through at least 350% crashes along the way. Rotating into international stocks when US lags can boost returns, but sometimes every market falls together and international offers no refuge. Most tactical strategies solve one problem at a time. They either time the overall market or they rotate between regions. Gary Antonacci's insight, starting with his 2010 research and formalized in 2014, was that you need both filters at once. One momentum signal protects against one failure mode. Two signals stacked protect against both. Dual momentum is a framework built on two momentum signals, stacked in sequence. First, relative momentum. Compare US stocks to international stocks. Over the last 12 months, which one performed better? Hold the winner. Second, absolute momentum. Before buying the winner, check if it actually outperformed risk-free treasury bills over the same period. If yes, you buy the equity. If no, you hold bonds instead. The combined logic is almost embarrassingly simple. Check 12-month returns on US stocks, international stocks, and T-bills. If either equity beats T-bills, buy the stronger one. If neither beats T-bills, you own bonds. Recalculate once a month. Two rules, one decision, one monthly check. The academic foundation comes from two separate bodies of research. Relative momentum has been documented since Jagadish and Titman in 1993. Absolute momentum, or trend following, was shown to work as far back as Faber's rediscovered research on long-moving averages. Antonacci's contribution was combining them into one simple, testable framework. Let me walk you through the exact mechanism. Two ETFs on the offensive side, typically SPY for US stocks and VEU for international developed markets. One defensive position, typically AGG for total bond market. On the last trading day of every month, you compute three numbers. The 12-month total return of SPY, including dividends, the 12-month total return of VEUU, and the 12-month return of 1-month T-bills, your risk-free benchmark. Step 1. Is the better of SPY and VEU greater than the T-bill return? If yes, continue to step 2. If no, put 100% into AGG. GG step 2. Between SPY and VEU, whichever has the higher 12-month return, buy that one at 100%. Next month, redo the calculation. Either reaffirm the current holding, rotate to the other equity, or rotate to bonds. No optimization, no curve fitting, no parameter tuning. Two rules. One decision per month. Over 56 years, from January 1970 through March 2026, dual momentum delivered a compound annual growth rate of 12.5%. The S&P 500 returned 10.7% over the same period. You beat the market by nearly 2 percentage points a year, compounded for 5.5 decades. Maximum drawdown of minus 19.6% versus the S&P's minus 55 in 2008. Volatility of 12.4%, lower than the S&P's 17. Sharpe ratio of 0.98 compared to 0.62 for the S&P. $100 invested in 1970 grew to about $60,000 by today. The S&P reached about $26,000. Dual momentum more than doubled the final value of buy and hold, with less than half the drawdown in every major crisis. Here is what 56 years of dual momentum looks like. The cyan line is dual momentum. The gray line is the S&P 500. For the first decade, the two lines look similar. Then you see the first real divergence in the 1973 stagflation. Dual momentum's absolute momentum rule pulled the portfolio into bonds ahead of the worst of the decline. S&P finished down 37. Dual momentum finished slightly positive. 1997, the Asia crisis and dot-com run-up. Relative momentum favored international, then US, then back. Dual momentum captured most of the bull market. 2001 to 2002, absolute momentum triggered defense. Dual momentum went to bonds while the S&P collapsed 46%. 2008 was the same story. Defensive before the crash, 15% drawdown versus 55% for the S&P. 2022 exposed the strategy's one weakness. When stocks and bonds fell together, dual momentum rotated to bonds near the peak. Then bonds kept falling. 18% drawdown, worse than PAA and the permanent portfolio. But over the full period, dual momentum finishes with more than double the wealth of buy and hold. Now let me give you the real picture. Dual momentum has three honest trade-offs. First, it is a binary strategy, either 100% in stocks or 100% in bonds. There is no graduation. When the rules are wrong, they are wrong with the full portfolio. Second, whipsaw risk during choppy sideways markets. If momentum is borderline for several months, the rules can oscillate, generating trades that do not add up to gains. Antonacci acknowledges this openly in his book. 1974 and 2015 were both whipsaw years. Third, the 2022 problem. When stocks and bonds fall together, the defensive rotation does not help. In fact, it can hurt because you rotate into bonds during the early phase of a rising rate environment, then ride bonds down. 2022 was dual momentum's worst non-crisis year since '74. This is not a theoretical weakness, it is structural. The strategy was designed for a world where stocks and bonds are negatively correlated. When that correlation flips, the rules need adjustment. Antonacci has written about this and suggested enhancements, but the simple two-rule version remains exposed. Let me walk through each major crisis. 73 to 74 stagflation, S&P down 37%. Absolute momentum went negative in early '73. Dual momentum rotated to bonds and finished the two-year period flat. 87 Black Monday. Dual momentum had recently rotated into international stocks, which outperformed the US crash. Small loss, under 5% for the year. 94 bond rout. The strategy was in US stocks. No damage. 97 Asia crisis. Relative momentum rotated away from international and into US stocks. Dual momentum captured the late 90s US bull market. 2000 to 2002 dot-com crash. Absolute momentum triggered defensive rotation in early 2001. S&P finished the three-year period down 46%. Dual momentum finished up 7%. 2008 global financial crisis. Defensive rotation triggered in December 2007. Dual momentum lost about 15% versus 55% for the S&P. COVID 2020. Fast crash, fast recovery. Dual momentum was briefly defensive, captured most of the recovery. Small drawdown, about 6%. 2022 is the outlier. Dual momentum lost 18%, its worst calendar year since '74. The model's blind spot in stagflation-like environments. Dual momentum is built for a specific kind of investor. First, people who want systematic rules with an academic pedigree. Antonacci's research is peer-reviewed. The two-signal framework is rigorously tested. If you want backing beyond internet backtests, this is one of the most academically defensible tactical strategies available. Second, investors who prefer simplicity over sophistication. 2 ETFs on the offensive side, 1 on the defensive, 1 monthly check. Your entire implementation fits on a post-it note. Third, people with a long time horizon. Dual momentum's value compounds over decades. Over 5 or 10 years, it often underperforms buy and hold. Over 30, 40, 50 years, the drawdown protection produces dramatically higher final wealth. Fourth, investors comfortable with full portfolio rotation. This is not a 25% allocation. When the rules say sell stocks, you sell all your stocks. If that makes you uncomfortable, dual momentum is not for you. Look at PAA, or the permanent portfolio instead. If you want to implement dual momentum, BestFolio tracks the live signal every month. You see exactly which asset is currently top by relative momentum, whether the absolute momentum filter is positive or negative, and the full allocation history back to 1970. We also track GEM Antonacci's simpler 2-asset variant and over 80 other tactical strategies with complete backtest data. Link in the description. If you found this useful, subscribe. I break down a different strategy every week with real data, honest trade-offs, and no hype. Next week, Kipnis Defensive Adaptive, a volatility-based tactical strategy that sizes positions by realized volatility rather than pure momentum. See you then.